Hello, everyone, and welcome to Fluent Financial's What You Should Know for the week of April 18th. Happy Tax Day, and I hope everyone had a great Easter weekend. My name is Mike Lanise, and I'm your portfolio manager at Fluent Financial. This past week, U.S. equity performance was mixed, as the week was shortened by the Good Friday holiday. The S&P was down 2.1%, and the NASDAQ was down 2.6%. But the Dow Jones Industrial fell only 0.78%. On a positive note, the small cap Russell 2000 index rose 0.5%. Earnings season began this past week, and financials took the biggest hit, down 2.5% after bank earnings disappointed. Other big news this past week, U.S. inflation numbers were hot, with producer prices climbing 1.4% month over month and 11.2% year over year, while the CPI, or consumer price numbers, inflation numbers, remained at elevated levels as they came in at 8.56%. For anybody asking, are we at peak inflation at this 8.56% level? At Fluent Financial, we don't think the highest rates of inflation have been hit as of yet, as we expect this number to continue to trickle higher as the producer price number continues to climb. Why is this the case? We would expect producers to pass along their costs to consumers and think that the producer price index number, or PPI number, needs to flatten out or even begin subsiding before we'd like to call peak inflation at the consumer or CPI level. The U.S. 10-year Treasuries finished just below the 2.83% as of Friday's close, and crude oil jumped 8.5% last week despite a large U.S. inventory build and demand concerns from China. In other economic news, U.S. retail sales figures for March, which are not inflation adjusted, rose from the prior month, largely due to a huge jump in gasoline prices, while online sales plunged. Consumer sentiment unexpectedly reached a 3-month high in early April, as job and wage growth optimism outweighed higher inflation. Industrial activity in New York State rebounded from March's drop, while production across the country rose for the 3rd straight month. If we look internationally last week, the European Central Bank kept rates unchanged, but did confirm that its bond buying program would end at the end of the 3rd quarter, and that's their stimulative program, so they want markets to cool down across overseas. British growth slowed more than anticipated in February, while soaring food, fuel, and energy costs both pushed the United Kingdom and German consumer inflation to multi-decade highs. If we look year to date, the Dow Jones is down 4.68%, the S&P is down 7.45%, and the NASDAQ is down 14.5%. Looking to the week ahead, we have earnings season for the 1st quarter accelerating, with companies in several key industry groups, including banks, trucking, airlines, metals, and technology, all reporting. Netflix releases earnings on Tuesday, having seen its share price cut in half since November under intense competition, while Tesla will be reporting on Wednesday, and that may shed some light on automotive supply chain disruptions. Johnson & Johnson is another key name that we hold, and they will be reporting Tuesday ahead of the Netflix earnings. If we look to the economic calendar this week, the U.S. economic news is a bit slow, but you have mortgage rates currently surpassing 5% for the first time in over a decade. So housing starts and existing home sales will be closely scrutinized on both Tuesday and Wednesday. On Thursday, the Philadelphia Fed Manufacturing Index comes out, followed by the flash PMI numbers on Friday. Feel free to leave comments or questions to this post. Click the like button and share it if you felt that it was informative. Subscribe to our YouTube channel, and visit our fluentfinancial.com website for further information. As always, thank you for tuning in to What You Should Know, and have a great week.